If you paid close attention to what happened to silver in 2025, you would have seen something that should make any experienced investor pause, not with excitement, but with quiet concern. Silver didn't just rise, it surged. By the end of 2025, silver had gained roughly 148%, one of the strongest annual performances in modern financial history. Prices moved from around $29 an ounce to over $72, even briefly touching highs above $86 at first glance. This looks like a spectacular bull market, but history tells us that when silver moves like this, the story is rarely about optimism, it's about stress. Because silver doesn't behave this way in calm systems. It behaves this way when pressure is building somewhere deeper out of sight, but not out of reach. This wasn't just a rally, it was a signal. When silver rises too fast, it doesn't celebrate growth, it exposes leverage. And when leverage is exposed, markets don't debate narratives. They demand one thing, immediately and without emotion: liquidity. And in 2025, liquidity started to become more expensive. That detail matters more than the price itself. If you understand what happens when confidence in money begins to fracture, when debt, leverage, and faith collide, then you know silver's move wasn't a trade, it was a symptom. Silver has always played this role at specific moments in history. Moments when people begin to question the stability of the monetary system they depend on. It doesn't scream, it reveals. At the same time silver was surging, gold was also sending a message. In 2025, gold recorded its best year in more than 4 decades, climbing roughly 65% and pushing beyond $4,300 an ounce. That alone would have been remarkable. But silver didn't just follow gold, it outpaced it by more than 2 to 1. That divergence tells us something important. This wasn't simply fear, it was acceleration. And acceleration in precious metals rarely appears in isolation. It usually emerges late in a cycle, when decades of policy decisions begin to converge into consequences. This isn't a prediction, it's a pattern. To understand what 2025 is echoing, we have to rewind. Back to 1979 and 1980, inflation was eroding purchasing power across the United States. The dollar was losing international credibility. Energy prices were exploding, trust in leadership was thin. Silver didn't rise because it became fashionable. It rose because people began questioning whether the paper money in their pockets would retain its value at all. In less than 2 years, silver surged from around $6 an ounce to nearly $50. That move wasn't driven by enthusiasm. It was driven by doubt. We saw the same pattern return decades later. During the 2008 financial crisis, as central banks printed trillions to stabilize a collapsing banking system, silver once again revealed its nature. Prices rose from around $9 an ounce to nearly $1.48 between 2008 and 2011. Every time the monetary system is stressed, silver behaves the same way. Not because it changes, but because the system does. Silver is not just an industrial input. It is real money that has survived every monetary experiment in recorded history. Now look at 2025 and 2026. The signals are familiar. Unsustainable fiscal deficits. Debts that can only be serviced by issuing more debt. Geopolitical tensions that increasingly challenge the dollar's role as the global reserve currency. And trade policies reshaping global supply chains, reintroducing inflationary pressures. Silver isn't reacting emotionally, it's reacting mechanically. To truly understand this, you have to understand how confidence-based monetary systems function. When governments can create money from nothing, they almost always create more than is prudent. This isn't moral failure, it's incentive structure. Politicians are rewarded for solving immediate problems, not for preserving long-term monetary discipline. Printing money provides short-term relief while pushing long-term costs into the future. Silver doesn't respond to speeches or promises, it responds to math. Governments create currency by decree. Silver requires time, energy, labor, and physical extraction. That difference is everything. And in 2025, something else amplified the move: institutional behavior. When large investors begin questioning monetary sustainability, they test the waters. 1% here, 0.5% there. In the massive gold market, that barely moves the needle. But in silver, one of the smallest major asset markets in the world, it creates shockwaves. Small markets magnify big decisions. And here's how this exposure is actually built. Most participants aren't buying physical metal. They're buying futures contracts, leveraged ETFs, and other derivatives. Leverage works beautifully until volatility arrives. When prices surge down from $86 to $72 in a matter of weeks, brokers didn't ask investors if they still believed in the thesis. They demanded more margin, and those without liquidity were forced to sell, often at precisely the wrong moment. This is how intelligent investors who are right about direction but wrong about leverage get broken. Being right doesn't protect you from being forced out. And this is where the story becomes less about silver and more about the system underneath it. Because systems built on leverage always look strongest right before they reverse. Thanks for watching. If you found this perspective valuable, be sure to subscribe for more insights. During long periods of stability, something invisible grows inside our financial system: leverage. Banks lend more, consumers borrow more. Corporations refinance endlessly, and governments spend far more than they collect. As long as asset prices keep rising, leverage feels harmless, even productive. Risk feels abstract. But leverage isn't strength, it's stored fragility. And when a shock hits a war, a pandemic, a banking crisis, the process reverses with brutal speed. Suddenly, everyone tries to reduce leverage at the same time. This is the moment when markets stop caring about long-term optimism. They care about one thing: survival. They care about cash. This is why silver behaves the way it does during these moments, not because it offers yield, but because it is no one else's liability. When you own physical silver, you own it outright. It doesn't depend on a central bank's promise or a counterparty's solvency. This distinction becomes everything when confidence evaporates. In leveraged systems, most assets are just claims on someone else's balance sheet. Stocks depend on earnings. Bonds depend on repayment. Silver doesn't, and that's why. During forced deleveraging, demand for assets outside the credit system increases dramatically. But this transition doesn't happen smoothly. Perception changes in waves. At first, a small group questions a system's sustainability. They diversify quietly, often dismissed as pessimists. But markets are social systems. When others see silver rise 148% in a single year, assumptions begin to crack. People start asking questions. Is my money actually safe? What happens if deficits never shrink? What happens if interest costs grow faster than the economy itself? This is how feedback loops form, accelerating faster than policymakers can control. History teaches us one principle again and again: mathematics does not negotiate with politics. If a government's debts grow faster than its productive capacity, there will come a moment when those debts can only be serviced by issuing more money. At that point, currency becomes abundant, and scarcity becomes valuable. Silver benefits not because it's speculative, but because it is finite. This isn't just theory. Imagine two neighbors in the late 1970s. Both worked hard and saved diligently. John saw rising inflation and a weakening dollar, so he quietly put 20% of his savings into silver at around $5 an ounce. His neighbor Michael thought John was paranoid. "The dollar is the world's strongest currency," he said, keeping his savings in CDs, earning 8%. It felt safe and responsible. Then 1980 arrived. Silver hit $50 an ounce. John's position increased tenfold. Michael was still earning his 8%, but with inflation averaging 12%, his real purchasing power declined year after year. Michael didn't lose money on paper, he lost it quietly. The difference wasn't intelligence, it was perspective. John was thinking about the system, Michael was thinking within it. Most people adjust the sails during a storm. A few ask whether the boat itself can survive. Silver isn't a profit engine, it's a life vest. You hope you never need it. Now, let's look at today. The U.S. has annual deficits over $1.8 trillion and national debt has crossed $34 trillion. Interest payments alone cost over $800 billion a year and are rising. Meanwhile, global powers are diversifying away from the dollar. Trade tariffs are creating new inflationary pressures. The Federal Reserve faces a dilemma with no painless solution: control inflation and risk recession, or support growth and risk monetary credibility. These are the inflection points that precede major monetary shifts. Silver is reacting exactly as history suggests it would. It's not rising because people suddenly like shiny metals. It's rising because intelligent players are questioning whether the current path is sustainable. The fact that silver dramatically outperformed gold in 2025 to 148% versus 65% tells us this isn't slow fear. This is accelerating doubt. Most people think inflation is just rising prices. But true inflation is monetary expansion. When the money supply grows faster than goods and services, your cash savings don't disappear. Their purchasing power does. For decades, diversification meant stocks, bonds, and real estate. But all these assets exist inside the same monetary framework. When that framework is stressed, they can all fall together. Just like in 2008. Silver initially dropped too, then it rose nearly 500% in the following years. Why? Because it was diversification from the system, not just within it. One final detail that's often overlooked: silver is accessible. With gold over $4,300 an ounce, a single coin is a major purchase for many. Silver, even at $72 an ounce, allows for gradual accumulation. This granularity matters. It enables disciplined, incremental preparation rather than emotional, all-or-nothing decisions. This leads to the question everyone asks: when should I buy? The honest answer is uncomfortable. You shouldn't try to time it. Silver isn't about perfect entries. It's about preparation. If you wait until the need is obvious, the opportunity is already gone. The goal isn't to maximize silver returns. The goal is to protect a portion of your wealth from risks that could affect everything else at once. And history shows that when those risks materialize, they do so faster than most people expect. If silver's recent rise is telling us anything, it's that the conversation is shifting from growth to preservation, and that shift changes everything. Most people approach silver with the wrong mindset. They treat it like a trade, something to buy low and sell high. But silver punishes that behavior more aggressively than almost any other asset. It's one of the most volatile markets in existence. Just look at the price action of 2025, a move from $29 to $86, followed by a rapid pullback to the low $70s. All happened in months, not years. If you're not psychologically prepared for that kind of volatility, you will almost certainly make the worst possible decision at the worst possible moment. That's why your purpose for buying it matters so much. Buying silver as protection against systemic risk is fundamentally different from buying it to speculate. If you're buying it as insurance, you hope you never need it. You hope central banks regain discipline, deficits shrink, and confidence holds. But if those hopes prove misplaced, you want that protection already in place before the panic sets in. And like any insurance policy, holding silver has a cost. It doesn't pay interest or produce cash flow. It often underperforms during periods of stability. That opportunity cost is the price of peace of mind. Trying to time silver perfectly is usually a losing strategy. A more prudent approach is to define an allocation target and build toward it gradually. Historically, conservative wealth managers have recommended 5 to 10% of net worth in precious metals during periods of monetary uncertainty. In times of more severe stress, some increase that to 15 to 20%. There is no universal answer. What matters is aligning the strategy with your own circumstances, your income, liquidity needs, time horizon, and risk tolerance. Once you decide to include silver in your strategy, the form matters. Physical silver offers maximum insulation from systemic risk, but it comes with storage and liquidity considerations. Silver ETFs offer excellent liquidity, but they remain part of the very financial system you're trying to hedge against. And mining stocks offer leverage to silver prices, but they introduce a whole host of other risks unrelated to silver itself. Each option has trade-offs. Many experienced investors choose a blend, not to optimize returns, but to balance protection, liquidity, and flexibility. Costs matter too. Physical silver often trades at a 15 to 30% premium over the spot price. ETFs carry annual fees. These aren't reasons not to act, but they are reasons to act deliberately. One metric often cited is the gold to silver ratio. Right now, it's around 59 to 1. Historically, the long-term average is closer to 40 to 1, suggesting silver might still be undervalued relative to gold. This is especially true if industrial demand continues to grow with the energy transition and new technologies. But even that misses the deeper point. Silver's role here isn't tactical, it's structural, and structural shifts don't resolve quickly. Even long-term holders should have clear criteria for when to reassess their position. Decisions made calmly, in advance, are almost always superior to decisions made under stress. If you study the last century of monetary history, a pattern emerges. Confidence-based systems eventually face credibility tests. Why? Because political incentives make long-term discipline incredibly difficult. Silver didn't rise 148% in 2025 because it's fashionable. It rose because it cannot be created by decree, diluted by policy, or erased by accounting. In a world where trillions can be created with a few keystrokes, scarcity becomes increasingly valuable. Silver also has extensive and growing industrial demand in renewable energy, electronics, and medicine. This dual role as both money and a critical commodity creates a unique dynamic, but none of this suggests you should abandon balance. Silver is not a replacement for productive assets. It's a counterweight. History shows that monetary transitions tend to be fast, disruptive, and emotionally charged. Those who prepare benefit. Those who react suffer. The question isn't whether another period of monetary instability will occur. The question is whether you'll be prepared when it does. Silver is not about getting rich. It's about staying whole. And the move we witnessed in 2025 was not the end of this story. It was the opening chapter. Because when perception shifts begin, they don't reverse easily. And this is where the final actor enters the narrative. The Federal Reserve. While the Fed doesn't control silver, it controls liquidity. And when liquidity changes, everything changes. This is where these stories usually end. Not with victory or collapse, but with transfer. Assets don't disappear. They move. From the leveraged to the conservative. From the impatient to the patient. From those thinking in months to those thinking in cycles. The best decisions are always made before the storm, not during it. Because once volatility arrives, choice evaporates. But preparation does not. Thanks for watching, and don't forget to subscribe for more insights. And this is where the Federal Reserve finally steps fully into the frame, not as a villain, not as a savior, but as the central actor, trapped inside the very system it helped build. Because the Fed doesn't control silver, it controls liquidity. And when liquidity changes, everything else follows. When interest rates rise, leverage suddenly becomes expensive. When rates fall, capital floods back into risky assets. But in late-cycle environments, like the one that seems to be forming now, the Fed's tools stop producing clean outcomes. Every decision seems to fix one problem by inflaming another. If they tighten too much, something breaks. If they ease too much, their credibility erodes. Silver doesn't react to Fed speeches. It reacts to these constraints. Because margin lives downstream of liquidity, and margin is where narratives die. When volatility spikes, like it did in 2025, Brokers don't negotiate, they issue margin calls. And those calls don't care whether your long-term thesis is correct. They only care about one thing, whether you have cash. If you don't, your position is closed for you. This is why these episodes never end in universal victory or universal collapse. They end in asset transfer. Those who entered with leverage sell under pressure. Those who entered treating it as insurance. They wait, sometimes even adding to their positions quietly. In these moments, money doesn't just vanish, it moves. It moves from the impatient to the patient, from the leveraged to the conservative, from those thinking in quarters to those thinking in cycles. This is how every single monetary transition in history has unfolded. The Roman denarius, the Spanish silver standard, the British pound, the Bretton Woods dollar, none of them collapsed overnight. They weakened, they distorted, and then they reset. And those resets always happened faster than the public expected. What we are watching now is not really a silver story, it's a confidence story. Confidence in perpetual deficits, confidence in infinite refinancing, confidence that monetary expansion can solve deep structural problems without any consequences. Silver doesn't argue against that confidence, it simply prices its absence. That's why the 148% move in 2025 matters so much. Not because of the number itself, but because of the timing. This move didn't happen during a panic, it happened during a period of relative calm. It happened during record asset prices, during strong employment data, during official reassurances from the top. And that's when the smartest signals usually appear. It's why preparation always feels unnecessary, right up until the moment it isn't. Silver is not an investment thesis. It's a contingency plan. It doesn't mean you expect a total collapse. It means you understand incentives, you understand cycles, and you understand mathematics. You understand that systems built purely on confidence will eventually face moments where that confidence is tested. And when that test finally comes, the adjustment is not gradual. It's sudden. History teaches us this lesson relentlessly. The time to prepare for a storm is when the sun is still shining, because once the clouds gather, the choice is narrow. Liquidity evaporates, and patience becomes the rarest asset of all. The storm is not guaranteed to hit tomorrow, but it is always somewhere on the horizon. In silver, quiet, volatile, misunderstood, silver has always been one of the first places where that horizon becomes visible, not because it predicts the future, but because it remembers the past. At the end of every cycle, people make the same mistake. They look for villains, they look for heroes. They look for a single event they can point to and say, that's when it broke. But monetary systems don't fail that way, they fail slowly, then all at once. What we are living through right now is not a moment, it's a phase. A phase defined by accumulated decisions, decades of borrowing future stability to finance present comfort. Each choice was defensible in isolation, but in aggregate, devastating. This is why silver matters. Not because it offers certainty, but because it exists outside of the storytelling. Silver doesn't care about election cycles. It doesn't care about press conferences, and it doesn't care about forward guidance. It responds to balance sheets, to incentives, to cold, hard arithmetic. That is why, throughout history, silver has never warned loudly. It never needed to. It simply adjusted its price as confidence thinned. The people who noticed early were rarely celebrated. They were called pessimists, alarmists, relics, until they weren't. Think back to 1929. Most people didn't lose their wealth in the crash itself. They lost it afterward during the deflation, the bank failures, and the forced liquidations that followed. Or think of 2008. The real damage wasn't the scary headlines. It was the slow, dawning realization that correlations had failed, that diversification wasn't protection when the system itself was under stress. Now, think of today. Record debt, persistent deficits, monetary expansion treated as a permanent tool rather than an emergency measure. These conditions don't guarantee a collapse, but they do guarantee instability. And instability is where silver has always lived. Here's the hardest truth to accept. Most people don't lose wealth because they are wrong. They lose it because they are unprepared. They are forced to sell at the worst possible time. They are overleveraged at the wrong moment. They rely on liquidity that vanishes the second everyone needs it at once. Silver doesn't solve those problems, but it helps you step outside of them. This isn't about betting against the system, it's about acknowledging that systems change. And when they do not send invitations. The people who fare best during these transitions are not the boldest or the fastest, they are the calmest. They think in decades, not quarters. In incentives, not headlines. In structure, not sentiment. That is why silver is best understood not as an asset but as a mindset. A reminder that scarcity has value, that promises have limits. And that confidence, while powerful, is also incredibly fragile. The 148% move in 2025 was not an anomaly. It was a message. Not a message to panic, not a message to speculate, but a message to pay attention, because when markets begin to price distrust even quietly, is never random. And history is very clear about what happens next. The transfer of wealth always continues. From those who chase to those who wait. From those who leverage to those who preserve. From those who think the cycle is over to those who know cycles never end. They only change form. Silver doesn't tell you when the storm will arrive. It tells you that storms are a natural part of the landscape, and the worst time to learn how to prepare is when the wind is already rising. Thanks for watching. If this made you think, consider subscribing for more content like this. Stay prepared.